Okay, let me welcome on board our next speaker. Jim O'Neill from Chatham House joins in to make sense of what's going on in the market right now. Jim, hi, afternoon. Great to have you today on ET Now. Jim, just looking at the market landscape, I mean, not just markets like India have seen a huge FI sell-off greater than what we saw in the COVID outbreak, or for that matter, the 2008 financial markets. But that said, I mean, how does one steer through these volatile times? Because it's not just equity markets. I mean, look what's happening on crude, for instance. Look what's happening with agri-commodities. It's not like we've not had wars before this to which markets have not reacted. But how do you explain what's happening in the world right now?
You know, to be quite honest with you, I'm finding it very hard to process. Just in the past 5 hours, the move in key global commodities is spectacular by the standards of many of the crises that I've lived through over the past 35 years. And it's reflecting the fact that this invasion into Ukraine is, first of all, badly influencing the supply of crucial global agricultural products, particularly wheat. And obviously, the more we all get in horror about what Russia's doing, the more aggressive our responses are being in terms of sanctions. And with the talk of oil restrictions, the energy markets, particularly oil and gas, have gone completely crazy. So if you use any standard model that I've been involved in for nearly 40 years, if we sustain these price increases of the past week, we are looking at a massive slowdown in the world economy. I helped create what I'd call an oil-adjusted financial conditions index when I was in my relatively early time at Goldman Sachs, and it became a powerful leading lead indicator. And the tightening in oil-adjusted global financial conditions in the past fortnight is horrific. And so it's reflective of the scale of what's going on. You say we've had wars, but we have not had, certainly in my lifetime, in Europe, anything as close to this involving one major power that just so happens to be at the center of global commodity markets. And the worse it gets, the more markets are, I was going to say understandably, I don't know if it's understandably, but the more markets are panicking. It's not entirely surprising, especially because, frankly, if you look at what Russia's said this morning about supposed safe corridors, it is almost an insult to people around the world. The idea that they're going to encourage people wanting to flee their own country, that the only safe passage out is to go and live in Russia, is just it's an insult to mankind. It's horrific.
Indeed, and bizarre to even issue a statement like that. I completely concur with you. But just to the point that you were making, Jim, it's unprecedented what you're seeing across commodity baskets. I mean, in just the last week alone, you've seen WTI crude jump up 20%. We're staring at $130 per barrel on crude. And not just that, wheat, aluminum, gold, right, dollar itself. And I'm going to talk about dollar shortly after this. But where lies the answer then? Because, the inflationary impact of what's going on in Ukraine and Russia is being felt across the globe and here in India as well. I mean, what do you think central bankers are going to do? And do they really have the answer to this situation right now?
So I think the answer, the real answer, and I caught the back end of your previous guest, the real answer is, to be honest, and I'm feeling a very downbeat but candid mood. The real answer is somebody getting rid of Putin, because if Putin is allowed to carry on this approach, we are going to have to get used to many aspects of the interaction of world markets, including commodity prices, that we have not seen for decades. And it will cause so much disruption to the status quo that it's very hard for people, including myself, to completely get our heads around, to be honest. And so for central banks, coming to the specific of that question, I can't imagine how they can be seen as a solution. Obviously, headline consumer price indices are gonna rise sharply in coming weeks, but whether that's genuine inflation or not it is very much open to dispute, because if something did happen and there was an end to this war suddenly out of the blue, commodity prices would completely collapse again, and within weeks, people would be worrying about a dramatic fall in inflation. So central banks have suddenly got themselves an enormously complex decision to make. If I would have been having a chat with you literally 2 weeks ago, I would have said confidently that the Fed is going to tighten 25, maybe 50 at its next meeting. Bank of England definitely going to tighten. ECB is probably going to tighten. But now I'm not so sure, because are they going to add to the pain of the implicit slowdown coming ahead all over the world? I don't know. It's very, very tricky.
It is tricky indeed, and to the point that you were making about getting rid of Putin seems utopian as of now, Jim. But anyway, that aside, so where lies the solution? Because what you're seeing in the markets and across the globe right now are unprecedented times, like you described. No one knows which way this madness is going to head, be it in the commodity markets, in the equity markets. And how should one really navigate through this volatility, specifically when it comes to equities?
So, I hear two questions there. Again, on the solution, it's a brave person that has a confident view, because what has to be figured out is to whether sanctions will accelerate an uprising of Russian people to overthrow Putin, frankly, or maybe there should be a two-pronged approach. At the same time, some kind of gesture that makes Putin at least present the idea that he's won. So I don't know, maybe some new method for agreeing membership of NATO. Maybe that could be offered as a win. And if there was some agreement on that, then that itself would probably cause a significant recovery in the markets. On the deeper question of how do people navigate, I think it depends on what kind of investor we're talking about. For investors that don't need cash, I think this is literally one of the cases, in my opinion, where you just have to hold tight. And if you have equities invested for reasons that seemed sensible before 2 weeks ago, I don't think investors should be panicking unless they desperately need the cash. Some investors are going to have to, because they will have money invested on behalf of funds, and investors might be seeking or might be having people wanting cash out, so they have to sell. But for longer term people that are trying to look at the long-term value of equities, I would not sell here. And indeed, for anybody that actually had some cash that they were looking to invest, we are probably getting close to the time where it is worth turning off the TV and radio and just putting some of that cash to work. Because having gone through a lot of crises, nothing quite like this, but many crises, including just COVID 2 years ago, the one thing we know is that crises do come to an end, and markets respond accordingly. And often, as sad as it is, because of the nature of how crises interact with markets, the best opportunities for investors often come through crises.
Yes, Jim. Hi, this is Anish also joining in. Yes, best opportunities do perhaps come in time of crisis, at least for stock investors. You say don't sell out and make perhaps fresh investments, but where to make those fresh investments? Where does India stand in the pecking order? Because I was just going through one of the reports that said that India is much better placed as compared to other countries, given the fact we have a good amount of forex reserves, and even if you look at the oil to GDP ratio, it's much better than what it was historically. Where do you see India in this entire setup?
Well, I often think when we go through these kind of events, which frankly seem to be getting far too frequent, that because India is a country or a nation of over 1 billion people that has a lot of its economy based on its own domestic markets, it does give it pretty powerful strategic advantages compared with many other places in the world. It's the flip side of being so interconnected to world trade. I guess what I'm really trying to say is that India has more control over its own destiny than many other places. So I think that does give a lot of inherent persistence, if not necessarily the quality of the strength of Indian economic growth. And it should mean that India would be amongst the places that will be set to recover the most dramatically as and when things calm down, if they do.
Yes, perhaps one of the economy which is set for a dramatic recovery as and when things improve. But the other buzzword that we have been reading in a lot of headlines right now, Jim, is stagflation. We have countries like China which have set their GDPs at the lowest level since 1991 in terms of the estimates. We have IMF headlines talking about how Ukraine-Russia will have a very big impact as far as the global economy is concerned. And on the flip side, we have the commodity prices. What's your take on stagflation and the way the bond yields are moving as well?
I mean, as I said to a previous question, if I look at what's going on here in terms of energy prices, and if I add it to the move we had already seen in January in terms of rising bond yields and weaker equities, translated into what I would call an oil price adjusted financial conditions index, that would be telling me that all else being equal, the world economy will slow very sharply through the second quarter and beyond. So the fears of stagflation are quite justifiable. And if there are parallels in the past, and I had already been thinking about this, there are unfortunately so far this decade quite a lot of parallels with parts of the 1970s when there's the last time around many parts of the world we genuinely saw stagflation. And we have unfortunately a lot of those ingredients. Unless we can somehow get this Ukraine situation under permanent control, and unless we can get some of these global supply chains that were there under struggle already because of COVID under control, we're going to have quite a lot of price pressures that's going to affect supply. And because of the shock going on to real income growth, we're going to be seeing weaker economic growth in many places, unfortunately, even though ironically, the latest absolute leading indicators for February in many parts of the developed world were very strong. But it won't last given what's going on.
Jim, afternoon. Just to delve further into the India impact, I'm aware you spoke of it, but certain market voices seem to suggest that given that the policy environment in India continues to remain strong as compared to the rest of the globe, we would in some way be a little more insulated to the kind of tensions that we're seeing across the globe. Would you tend to concur with that, and how are you looking at the overall macro setup in India?
I mean, I think that is in itself it's true, but again, Indian markets have often been affected strongly by moves in oil prices, and with literally what we've seen just in the hours that markets have been open since Europe woke up, this size of move in energy prices is not going to be favorable for India. India is perhaps less dependent on oil than it was, but India is a big net importer of oil. And this is why throughout many cycles since the 1970s oil price shocks, many of us have been trained on these models that look at the impact of big rise in oil prices. And it is the case that a lot of big oil importers get really badly hit when we see periods of very, very strong oil price increases. And that's what's happening.
So how would you stack India right now as compared to the rest of the world, owing to the kind of crude impact, what we're seeing on inflation, the currency, as well as the policy initiatives that have been taken?
I mean, I think the thing that comes to the fore in these circumstances is, again, we're seeing played out in markets as we speak, so-called safe havens, even gold that's been such a sort of disappointing asset compared to sexy, fancy things like Bitcoin. Even gold is coming into its special own again in the past few days, as well as the remarkable power of the dollar. Being the world's major reserve currency, when you have such aggressive things going on in the world, including economic sanctions, purely serves to undermine the power of the dollar. And as we see, there's a lot of money obviously fleeing into the dollar and into US fixed income securities. And I think, yet again, and it's almost by the playbook, many so-called emerging markets just suffer nothing to do with anything that's going on in their country other than the fact that they're linked to a financial system which is dominated by the dollar. And if you look at the freezing of Russia's central bank's assets, which is a particularly powerful and aggressive move, it simply highlights the dominance of the dollar-based financial system to so many people around the world. And that is likely to also be an ongoing dominant part of the current financial market patterns, even though it seems to me on fundamental criteria that this dollar strength is not justified in the slightest.
Jim, you made a very interesting point earlier in our chat, saying that the only way for an investor is to turn off all the noise, turn off your radio, TV, Twitter, what have you, and invest in companies which are going to be resilient to all that's going on in the world right now. I wanted to understand, the big debate, for instance, here in India is what's going to change for IT after the October fall that you had, because some of these, NASDAQ companies were getting a little bit frothy in terms of valuations. And mind you, the same played out here for Indian IT companies as well. They're only getting more attractive right now. Similarly, another viewpoint is emerging that maybe it's time to try and position your portfolio to less fuel dependent, fuel sensitive companies, for instance. Is that really the way to go?
I do think what's happening to IT and tech companies is particularly interesting. I personally was quite concerned coming into 2022 that so many of the related moves in markets, including venture capital, which I'm personally quite active in, we're seeing very significant markups just because of the scale of the rally in the big tech stocks last year. And they've gone through a significant derating even without this move. But it's been exaggerated. Just as during your break there, I was reading online that a major takeover in the London market has been put on hold in this regard this morning, and I'd imagine we'll see more of that. And so we're going to see an adjustment in valuations across the board, I suspect, which does mean, especially because it's almost definitely the case that what the markets had expected for central bank tightening as of a month ago is not going to happen. I mean, we will get central bank tightening, but I don't think it's going to be 7 hikes of the Fed this year anymore, for example. It probably means that, and you see a little bit of this going on, that the tech sector gets re-rated compared to it literally where it was a fortnight ago. And given that that's where all the real growth engine of markets and the world economy arguably has been coming from, it sort of makes a bit of sense. So maybe in a strange way, the combination of past tightening and this chaos going on in the past fortnight is helping doing some of the work that otherwise would have still had to have happened. So I do think that looks a bit more interesting. I think if I understood your question right, stocks that avoid energy, I'm not quite sure what that means really, because of the scale of the price increase, and again, like I keep talking about, the tightening in financial conditions, the shock going on to so many real incomes that people will not yet have realized till they try and go and get some petrol or gasoline, or next time they go to a supermarket. People are going to have less money to spend. So unless these prices come back down a lot, then consumer spending on many items is going to be weakened. And so it sort of all goes back to the earlier discussion we had about where does this all settle and calm down and reverse, if it does, presumably, which obviously at one point it will do.
Okay, and we'll wait for that moment. But Jim, what I meant was companies which are into greener fuel. Well, we'll leave that debate for some other time. Great speaking with you today. Thank you so much for taking the time out.
All right. Thanks for having me on. Take care.